The topic which we have today is how to read and analyze annual reports. We will be looking at the objectives of reading an annual report. How to read an annual report takes us directly to the question as to what to read. And what to read comes from the objectives which each participant group wants to achieve by reading the annual reports. The objectives of reading and reviewing and analyzing an annual report can be broadly categorized into four broad perspectives. First is an investor perspective. What is it an investor needs to know by reading the annual report and by analyzing the contents of the annual report? Banking perspective, what would the bankers of the company be interested in, willing to know when reading and analyzing annual reports? A management perspective as to what would be the management and the employees or the stakeholders of the company be interested in knowing about the company from the annual reports, and others, which includes regulatory authorities, as to what they will be reading and what they would be interested in. The objectives of each of the groups of participants who will be wanting to read and understand the annual report would be different. The primary question which an investor seeks to ask is, does an investment in this company is likely to be fruitful? From the investor's perspective, the returns which the company is delivering vis-a-vis the rest of the market and the returns which the company is delivering vis-a-vis the risk which it is carrying on looked at. If an investor is already invested in the company, then he looks at an annual report in order to track performance and to see if any positive action is required based on the delivered performance. From a banking perspective, a banker is primarily interested in the ability of the company to service its borrowings and to ensure that all the covenants are compliant. If a lender is already on board, then he reads the annual report to check, will there be adequate resources available to service borrowings? Is the company following all the covenants which the banking system mandates in? How is the company performing so as to have a continued business association with the company? From a management perspective, management will be interested in understanding whether the business is earning a return which is higher than the cost of capital, which means either it is adding value or it is not adding value. If it is earning a rate of return which is lower than the cost of capital, then the company is not adding value. Every business deploys capital, and that capital is divided into two broad categories, debt and equity. The cost of equity would be much higher than the cost of debt for the primary reason that debt is a fixed obligation, whereas equity is a right to residual cash flows. The equity right is a right to the residual cash flow. Anything which is residuary will have a higher cost as compared to a fixed obligation. So the cost of capital for a company would be a combination of the cost of equity and the cost of debt. Evaluate the cost of equity. There are models available. One of them is the CAPM, which is a capital asset pricing model. But what it represents really is the investor expectations of return. From the regulatory perspective, whether it is GST, income tax or SEBI, they would read the annual reports to ensure that the compliances are in place. There is no evasion of taxes or evasion of compliances. Most importantly, a fairness check. Is the company operating in a just and fair manner on a public policy level?